Welcome to ARC Big Ideas 2026. Today, we're diving into the Great Acceleration, exploring how technological convergence is fundamentally reshaping the global economy. This isn't just about growth, it's about a profound structural shift driven by interconnected innovations. A core premise of our research is that linear forecasts are increasingly failing to capture an exponential reality. This disconnect arises because traditional benchmarks miss the compounding effect of technological convergence. We're not facing a single trend, but a step function change in economic productivity. The driver behind this phenomenon is the convergence of 5 innovation platforms: artificial intelligence, public blockchains, robotics, energy storage, and multiomics. These aren't evolving in parallel, they are highly coupled, accelerating each other's progress. The impact is staggering innovation-related assets, which comprise roughly 20% of global equity today, could expand to approximately 50% by 2030, growing market capitalization from about $5 trillion to an estimated $28 trillion. This also leads to a stark difference in GDP growth forecasts. While the consensus from the IMF projects global real GDP growth at around 3.1%, ARC forecasts a much higher rate of approximately 7.3% by 2030, reflecting this exponential acceleration. At the heart of this great acceleration is artificial intelligence. AI is the central dynamo, accelerating innovation across all other platforms. Consider robotics. AI provides the brain for general-purpose humanoids. In multiomics, AI decodes complex biological data to unlock root-cause cures. For space, reusable rockets launch the connectivity crucial for AI's global reach. On public blockchains, AI agents utilize crypto rails for autonomous settlement and transactions. And in energy, AI optimizes distributed grids to power the immense computational needs of the future. This convergence is not theoretical. Our convergence network strength metric, for instance, increased by 35% year over year in 2025, signaling a rapid mutual unlocking of these technologies. The physical build-out of the digital economy is accelerating at an unprecedented pace. We've seen inference costs collapse by over 99% in just 1 year. This dramatic price drop, an example of Jevons paradox, is fueling an explosion in demand. For instance, open router compute demand has surged 25 times since December 2024. This necessitates massive capital expenditure. AI infrastructure investment is projected to hit $14 trillion by 2030, and data center systems investment is growing at 29% annually, a stark contrast to the 5% pre-ChatGPT rate. Take AWS, for example. Amazon is strategically transitioning from being the store for everything to providing the infrastructure for everything. Their custom Trainium 3 chips offer a 4-fold performance boost, and their strategy involves sacrificing short-term free cash flow, with $125 billion in capital expenditures in 2025 to own the critical AI plumbing that will power the future. However, the energy equation presents both a crisis and an opportunity. The core conflict is a fundamental mismatch. Utility regulation typically evolves on timelines measured in decades, while AI infrastructure expands on timelines measured in months. This disparity creates significant challenges, such as interconnection queues and permitting backlogs. The solution lies in distributed energy and independence. Tech giants like Microsoft and Amazon are already bypassing the traditional grid, investing in technologies like nuclear small modular reactors and on-site renewables. Thanks to Wright's law, solar and battery costs continue to decline, effectively decoupling growth from the constraints of the centralized grid. The scale of investment needed is immense. Global power generation investment must reach approximately $10 trillion by 2030 to meet this burgeoning demand. Moving to robotics, general-purpose robots are poised to unlock a staggering $26 trillion revenue opportunity. We are witnessing a profound shift in robotics, moving from the caged and programmed models of the past to collaborative and learning humanoids. If these humanoids penetrate just 80% of U.S. households within 5 years, we project GDP growth could accelerate to an impressive 5 to 6%. This is because while manufacturing GDP currently stands at about $32 trillion, the value of unpaid household labor is approximately $13 trillion. Monetizing this invisible labor via humanoids directly converts it into explicit GDP, representing a massive productivity impact. We estimate that manufacturing labor productivity alone could see a potential increase of 100%. Autonomous mobility is set to dramatically collapse the cost of transportation. Today, a personal car costs around $80 per mile, and a human ride-hail service is about $280 per mile. But with the convergence of AI, robotics, and energy, we forecast that an autonomous robotaxi could cost as little as 0.25 per mile by 2035. A prime case study here is Tesla, which is shifting its focus from EV volume to its AI chapter, specifically its robotaxi or cybercab and Optimus humanoid robot initiatives. Our 2026 price target for Tesla is $4,600 per share, with the robotaxi business line contributing a significant 60% of that expected value. Their progress is evident, with full self-driving version 14 being quasi-level 4 and cybercab production slated for April 2026. Reusable rockets have been a game changer, lowering the barrier to orbit by an astounding 95%. This makes space the critical connectivity layer for the AI economy. Launch costs have plummeted from roughly $1,600 per kilogram in 2008 to under $1,000 per kilogram today, largely thanks to innovations like SpaceX's Falcon 9 and Starship. This creates a powerful flywheel effect. Lower launch costs lead to more satellites, which in turn provides global low-latency connectivity, enabling ubiquitous AI command and control. This isn't theoretical. Starlink alone now accounts for 66% of all active satellites in orbit, demonstrating the rapid realization of this vision. In the medical field, multi-omics and AI are fundamentally shifting medicine from mere treatment to true cure. This revolution is driven by three interconnected forces. First, cheaper data genome sequencing costs are plummeting, nearing just $10. Second, better models AI is uniquely capable of analyzing vast and complex multi-omics data to uncover insights. Third, precise drugs. AI design is shortening time to market for new drugs by 40%. The economic impact is profound. Drug development costs are projected to drop from $2.4 billion to just $700 million. Curative drugs for rare diseases, for example, are 20 times more valuable than chronic treatments. By 2030, we forecast that AI-driven diagnostics will capture approximately 30% of the market share, further accelerating this paradigm shift. Public blockchains are rapidly becoming the essential financial rails for our automated economy. While the internet transferred information, blockchains transfer value, a critical distinction, especially for AI agents that need to transact autonomously. The scale of this transformation is immense. By December 2025, stablecoin transaction volume is projected to reach $3.5 trillion, dwarfing the combined volume of Visa, PayPal, and global remittances by 2.3 times. Beyond transactions, tokenization is democratizing access to assets, with real-world assets expected to reach $11 trillion by 2030. Furthermore, DeFi protocols are demonstrating incredible efficiency, generating massive revenue per employee compared to traditional finance, highlighting the lean and powerful nature of this new financial infrastructure. Bitcoin has achieved significant institutional maturity, evolving into a distinct asset class that serves as both digital gold and an emerging market safe haven. As digital gold, it acts as a store of value, and as a safe haven, it provides protection against currency debasement. Institutional adoption is clearly growing. Approximately 12% of Bitcoin's supply is now held by ETFs and public companies. Correspondingly, its volatility is decreasing as this institutional embrace expands. Our forecast suggests that Bitcoin has the potential to reach a $16 trillion market cap by 2030, representing a compound annual growth rate of roughly 63%, solidifying its role in global finance. AI agents are fundamentally collapsing the consumption funnel, shifting us from a process of search and click to one of ask and receive. Consider traditional commerce a journey through awareness, interest, decision, and action can take hours or even days. In contrast, agentic commerce driven by AI streamlines this into just 2 steps: intent and fulfillment, taking as little as 90 seconds. This dramatic efficiency gain has a massive market implication. AI agents could facilitate $8 trillion in consumption by 2030, representing 25% of all online sales. This isn't just about convenience, it's about a complete re-architecture of how we interact with products and services. It's crucial to understand that the primary risks we face are institutional, not technological. Technology is advancing at an exponential pace, often moving much faster than policy can adapt. Success in this new era hinges on institutional alignment rather than simply technological optimism. We see this in several areas: energy regulation, where grid interconnection queues and permitting reforms are proving too slow to keep up with demand; global governance, which suffers from regulatory fragmentation and geopolitical misalignment that can hinder innovation; and labor markets, where the rapid displacement of tasks by AI and robotics requires careful social alignment to avoid friction and ensure a just transition. The window to recognize and invest in these transformative platforms before they scale to their full potential is rapidly closing. Our portfolio strategy is centered on owning the future, which means evaluating assets not in isolation, but based on their convergence network strength. This involves assessing factors like innovation velocity, revenue diversity, user growth, data integration, AI capabilities, and ecosystem reach. It's important to note that tech valuations today are more rational than often perceived. PE ratios are lower than during the dot-com bubble, despite higher capital expenditures. A key observation is that the market is still pricing linearly, while the underlying technology is growing exponentially, presenting a significant opportunity for those who understand this fundamental disconnect. In conclusion, our core message is simple: own what's next. As ARK Invest often says, the future doesn't arrive all at once. Those who recognize it early have the opportunity to own what's next. This future holds immense value, with projected market opportunities like $28 trillion in innovation-related assets, $26 trillion from general-purpose robots, a $10 trillion need in power generation investment, a $5 trillion current market for innovation assets, and a $16 trillion potential market cap for Bitcoin. These are the big ideas driving the great acceleration, and understanding them is key to navigating and investing in the transformative era ahead.